What I wanted to talk about today, this morning, first of all, we have round 2 of earnings reports coming this week. So we have Alibaba on Friday, Apple on Thursday. Tomorrow we're going to see Facebook and Pfizer, and then Wednesday we're going to have GM, another company we own, Ant and Blue Cross. Unemployment is expected to be at 3.7%. Payroll numbers are expected to come at 190,000 new jobs created for the month. What I wanted to talk briefly this morning is about the financial sector. I think the financial sector is another undervalued sector. We have 6 big banks that are not doing that great lately because a lot of analysts on the street think that we are at the end of the expansion cycle, 9th year already into it. And banks are quite a cyclical business. So if this is the end of the expansion business cycle, the fear is that loan growth is not going to be that great. Banks make money on lending money, and if that is not the case, money should not be invested in these names. So that's the general idea why not to be in the banking sector. The reality is we don't know if this is the end of the cycle, because the data that we see from the economy is still looking pretty attractive. We're still getting GDP growth rates 3.5%. The unemployment numbers are still good at 3.7%. Inflation still at 2.1, 2.2%. We don't know if that's the end of the cycle, because cycles don't die of old ages. And the 6 big names are Bank of America, Citigroup, Goldman Sachs, JP Morgan, Chase, Morgan Stanley, and Wells Fargo, of which the top 2 for investable assets, in my view, can be Bank of America and Citigroup. And the reason I'm bringing these 2 names to the forefront right now is because, number one, they are selling at 9 to 10 times earnings. Both of them pay nice dividends. Citigroup pays 2.8% in dividends. Bank of America pays 2.3% in dividends. They are both down for the year, anywhere between 9 to 12%. All the banks are down, with the exception of JP Morgan Chase, which is trading flat. So price to tangible book value with Citigroup is 1 time. Bank of America is 1.5 times. And just for you guys to have a comparison, JP Morgan Chase is 1.9 times, almost 2 times. So when banks trade close to book value, for us, it's a good indicator that a bank is not that expensive. With Bank of America, some analysts think that they can, by 2022, do $4 a share. Their loan growth is only 3%, mainly because they are extremely conservative. Last quarter, they actually had increase in earnings per share of 43% to 66 cents a share. So my thinking is being a contrarian on the banking industry is not a bad idea, especially considering that the market trades at 17 times earnings and these guys trade at about 10 times earnings on average. One last thing I wanted to talk about, we keep talking about some indicators for a slowdown / recession one day. And there is another indicator that I'm going to bring to a discussion today, which is the spread between inflation rate and unemployment. So historically speaking, when that spread was wide, that was the beginning of a new cycle. Think about it. At the end of a cycle, the unemployment increases and the economy is not growing that greatly, so inflation drops. So the spread between inflation and unemployment is extremely wide. And as we get to an expansionary cycle and more people are hired, the unemployment drops, and at the same time inflation starts picking up, and that spread narrows. Nowadays, that spread is at about 1.2, 1.3%. The spread is narrowing down. When that point comes where we are at even, which means no spread anymore between unemployment and inflation, that can be another sign for a turnaround for us, a recession in the market. The only country that the spread, I think, is still wide enough, 3% or more, is Australia. One day it's going to come. I don't think it is now.